We will get started. Thank you for joining us today. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority. I'll be your host today for the Small Business Boot Camp. One of the things I like to do, if you've been on the boot camps before, you know that I change my backgrounds around a bit and like to share where that's been. So if you look at my background, I'll give you a little more room. That is Picture Canyon and Flagstaff. So if you're trying to get out of the heat and you're up at Flagstaff, you can go to Picture Canyon, real easy to find. And it's a pretty couple different hiking loops you can do that are pretty easy, but it was a gorgeous, easy hike right there close to Flagstaff, right in town, basically. Really cool hike. So anyways, for those that are new to the boot camp, we like to start by thanking all of our community partners. We cannot do these boot camp sessions without them, their time, their effort, and their expertise. And this is just a sample of our community partners. We have well over 120 partners that have worked with us with almost 200 different presenters over the last 3 years, and we could not do these without them. So what is a Small Business Boot Camp? It is a webinar series and a series of workshops that help support small businesses in Arizona as a prepare, plan, and grow. Not only is it the 9 a.m. webinar every week on Tuesday mornings, every quarter, or sometimes more than every quarter, we do a workshop. Our next workshop is on August 9th from 9 to 11 a.m. We'll talk a little more about that in a second, but that workshop is coming up, and we have some others we are working on and plan to help businesses as well as part of the boot camp program. Another great part of the boot camp is that we record all of our webinars that we host, and many of the workshops we've also been able to record, and we post those in our content library. And so in the content library, we have a diverse collection of well over 250. It's closer to probably 280 to 300 different webinars that are recorded with the presentation and the slide decks for them. So it's a great resource for you to access. And as you can see on the screen, we have an ability to sort through those 7 different categories to make it a little bit easier to find the topics you might be looking for. But because there are so many in there now, if you do have trouble, feel free to reach out to me, and I can guide you to a webinar or two that might help you with your needs. Additionally, the Arizona Commerce Authority has a number of programs that help support small business. We have our Arizona Career Readiness Credential, the Arizona Innovation Challenge, which is the state's largest business plan competition. It's one of the best in the country, and that application window for that program is actually opening up this week. So if you're a tech startup, that is a great opportunity for you. We also have our Arizona MEP, which is Manufacturing Extension Partnership, that helps provide support to Arizona's small and medium-sized manufacturers. Our Arizona State Trade Expansion Program for those looking to export their goods and services to new markets. And then our Arizona at Work that works with employers for employees. And then our Small Business Services, which I oversee, and we help with the education, our checklist, and other programs. So I mentioned the checklist. That is the next piece. The Small Business Checklist is an online interactive tool that small businesses and entrepreneurs can use to identify the commonly requested licensing, registration, and compliance needs at the local, state, and federal levels. You can also find a lot of other information related to starting and growing your business on that checklist. And it is a very in-depth and robust tool, very easy to use. You just check the item that you're interested in, and then you hit see results, and it'll give you the information for those items you checked. For quicker, simpler questions, you can utilize our virtual assistant, Sally, that will pop up in a little chat when you are on the checklist page. So that's also another great resource. So sharing some updates. Again, I mentioned the small business workshop on August 9th. That is presented by the ACA and the Phoenix Business Journal. with some support from Wells Fargo and Blue Cross Blue Shield of Arizona. We're excited to have that. We're going to be talking about preparing for growth in the remainder of 2023 and beyond. So we'll post the link for that information in the chat. If you're interested in that, it is in person only, and there is a slight $20 fee for that. But that is something that is available to everyone to attend in person. Additionally, we are currently accepting applications for the Small Business Digital Academy that we host every quarter. It's a great entry-level cohort style class, 3 weeks that we go through the basics of the digital world that most small businesses are now facing. You can apply, we have this week left to apply. Applying is only a part of it. Once you apply and you're accepted into the program, for those that have applied already, there are additional steps that you will receive in an email to be part of that cohort. And there's no cost to be part of it. So if that's something that interests you, please check it out. Again, we'll post in the chat the information and the links for the information on this program. And then, as I mentioned, the Arizona Innovation Challenge is applications are opening this. I think they open today, if not the next day or two. And we'll post the link to that as well in the chat. So some of our upcoming sessions for the boot camp for the next 3 Tuesdays, we have eliminating obstacles of building a profitable plan, best practices for commercial real estate for small businesses. This is really important. This is focused on the tenant side, which is small business owners. So if you are a small business owner and you're in a space, this may be a benefit for you and interesting. So enjoy us for that. And then August 22nd is embracing authenticity amidst copycat culture. So we've got a bunch of great upcoming sessions we're excited about. So please join us every Tuesday if you can at 9 a.m. And thank you for being here today. And with that, we're going to jump into today's session. Today we have Mark McKenna. He's a business development officer for Prestamos CDFI. They're a local lender, a community-based lender that we've done a lot of work with. And Mark is one of their experts. And so, Mark, I will turn the time over to you. I'll stop sharing, and it is all yours.
Awesome. Thanks, Robert. I appreciate it. Thank you also, Faith and Arizona Commerce Authority for having us on board today and sharing what I believe to be some very crucial information at the start of a lending process. Today's topic, the 5 C's of credit. Again, being in the industry and in banking for over 15 years and in the finance industry now over 25 years, one of the first things that I learned in my position were the philosophy behind the 5 C's of credit. So today I want to share that with you. Again, thanks for having us on board. Let's kind of continue here. I want to just share a little bit. Oh, let me share the screen here. Let's let me know when you can see the screen.
All right, you're good.
We're good. Awesome.
Yeah.
All right. So as Robert mentioned, I'm Mark McKenna with Prestamos CDFI. And about us, we're part of a large organization, a division of Chicanos por la Causa. We've been in the community now for over 53 years. In the lending part of it since 1980, believe it or not, doing small business loans up to $500, starting at $500 way back in the day. But we're a community development financial institution. And basically this designation through the U.S. Treasury allows us to serve, those underserved communities through lending, business consulting services, investment opportunities in Arizona, California, Nevada, New Mexico, and Texas. A couple I'd like to just talk a little bit about our highlights with some of the other parts of our organization, our Small Business Women's Center there in the Phoenix Valley. the Minority Business Development Agency. We have an office located in Nevada. During the last 2.5 years, and working with the Payment Protection Plan with the SBA, we were the #1 US SBA lender, serving over 400,000 small businesses. One thing I like to highlight in that particular scenario is our average loan was just a little over 15,000. So we truly are focused on that small business environment. Recently, we've come out of the Maricopa County Loan Resilience Program and deploying just a little over 26 million under that program. And down south in the Santa Cruz County, we just deployed on $1 million forgivable loan program there. So that's who we are, a little bit about what we do. And let's get into the 5 C's of credit. I'd like to give it maybe a minute to see if I can get some responses on the 5 C's of credit, and if I can get anybody to put in the chat there some of those C's that we look at under the 5 C's of credit. So let's just give it a minute and see if we can get some responses from anybody out there on what those 5 C's are. Anything in the chat?
Yeah, we got collateral, character, cash, capital, consistency, credit utilization.
Awesome. That is awesome. So, and let's go. You guys are right on. You guys are right on, and I appreciate the participation there. But the 5 C's of credit, right? Somebody mentioned collateral, capacity. We also otherwise known as cash flow, right? Character, capital, and conditions. Those are the 5 C's of credit. The capacity component, somebody's ability to repay a loan by comparing income against reoccurring debt. Collateral is what we use for assurances over the loan, a security component. Character, a lot we use is credit history when we identify the character piece. Capital, your skin in the game, right? Stake in the game. What do you have to put into this project where you're requesting some money for? And conditions, uses of funds, the interest rates, the whole term on the actual loan itself, and economy, also, as part of that piece. But here are the 5 C's of credit. And I kind of highlighted these first 3: capacity, collateral, and character. And those are the ones that really we identify as the ones that we focus on primarily when we're doing a pre-assessment of a loan application. Okay, let's go to that next one. Let's talk capacity, right? Cash flow, huge. And here, we need to be sure we're not going to lend money without a borrower's ability to repay that loan. So at the end of the day, this is what we're looking at, and this is going to be what's going to put us over, any challenges that we see in terms of lending. So we need to be sure, that the borrower has the ability to repay the loan based on their proposed terms and the amount of the loan. But some of the things I'd like to highlight here is how we come across this, right? How we look to get what we call our debt service coverage ratio. And these ratios really help us determine the strength of someone's ability to repay. And at the end of the day, this DSC, right, ratio, out on a retail banking environment, typically lenders are going to want to see 1.25 or above. And what this ratio is, basically, in a nutshell, it tells us for every dollar you spend, you're earning $1.25. And that's what it comes down to. So that's what we look at, and that's what lenders look at in terms of strength on repayment, is that DSC. We, as a CDFI lender, we want to focus on also businesses below that. So we'll do one-to-one, and some of this consideration is for small business owners, or I'm sorry, startup business owners, right? Startup companies, or those businesses that maybe are seeing a challenge in terms of cash flow, right? And they're at that starting phase, maybe they're a year, 2, 3 years into the business, and cash flow is tight until they make that break-even point for their business. So this is something that we really want to consider, and we look at a lower ratio than a normal retail banking environment. Outside income for startup businesses, this is huge, because we'll do a global debt service coverage. So we'll look at, so for those new startup businesses, we look at existing jobs that they have, and we incorporate that cash flow into this. And we call this outside income, which helps for the cash flow. One of the first things that we'll look at in terms of where a business lies is reviewing the current P&L statement and balance sheet, okay, for a business. So this is something, when I get applications, when I was in banking, the first thing that I wanted to see was a current P&L and a current balance sheet. These were the two documents that helped me kind of do a preliminary assessment in determining somebody's strength in that repayment process. Understanding debt obligations is huge. And this, we look at from the balance sheet, but also having a good understanding of your business debt is going to be huge. Future projections for startup businesses, future projections for experienced businesses that are looking to expand and scale up their business for expansion. In those particular scenarios, it's important to see what the projected income is going to be for additional inventory that they're requesting, for additional square footage space they want to build out on a building they own, or even to lease additional space. And they need money for that. So that additional space means additional revenue. So how do we identify that? We identify that through the projections. So looking at lending needs or borrowing needs, the projections are going to be huge in those circumstances. One of the Israel Gibbs from First Citizens Bank, a partner of ours, he says, is the borrower able to repay the loan? But I think one of the crucial things in this particular statement is, are they willing to repay the loan? So there has to be also a lot of engagement in that process. And I think it's important to understand from a borrower's perspective how engaged they are and how willing, and the steps that they're going to take to make sure, that they offer assurances in that repayment process. So that's something that also we always want to look at. But at the end of the day, we're not in the business to put businesses in distress. If we feel that a loan is too much of a request based off of what we're looking at in ratios, we're going to probably recommend a lower amount and look at the actual uses of funds and find out and determine what does the business actually need as opposed to what they want. So the last thing we want is to put undue stress on a business. Okay. Are there any questions out there on this? Now we'll move to the next slide. Collateral. So here's the another part. With this, in our lending programs, we're always going to look for security interest to secure the amount of the request, whether it be through equipment if somebody wants to purchase, or whether it be a building, commercial real estate. We're going to use those. On the other side of that, a lot of times we have requests for inventory, working capital. On expansion, people want salary expense. So because those aren't necessarily tangible items, we'll look to see, well, what existing business assets are there to use as collateral. And a lot of times we actually will use a private resident. So personal residence from business owners, they'll use that as security interest for that loan amount. So collateral is huge, and it strengthens, excuse me, an application in terms of, and I want to explain, one thing, and a lot of times I'll get into conversations and borrowers will, look at that collateral and based off of the amount of the collateral, feel that it's justified for lending. So if somebody has $1 million piece of collateral and they want a $100,000 loan, sometimes we get the question is, I had this, why can't I get the money? If I don't pay the loan back, you have my collateral. But again, one of the things that I like to explain, to our borrowers, to our clients, is those are worst case scenario situations, that we get in. If a client defaults on a loan, the worst case scenario we want to do is repossess any business asset or a personal home. And it's there to protect a portfolio, but at the same time, that's the last thing that we want to do. And one of the things also is, in terms of collateral, we're not liquidators in a sense where we can go out and find, the best buyer for a specific piece of collateral. And this is important to understand, because when we do and we assess value of collateral, we'll give it less than its actual market value. A piece of equipment that an owner knows out in the market, they can get 80% loan to value, but we're only going to really value that piece of equipment at 50% or even less in some cases, depending on how old it is. So that is important to understand in that piece. Collateral just offers that security position in terms of a default, but those are worst case scenario situations where we really don't, calculate into, the actual decision of the loan, other than just assurances or strength if in the event of a default. Some of the things, again, I mentioned real estate, but equipment, could be tractors. Not too long ago, we did a company and he's a leather manufacturer. So he needed a leather machine press. That was $100,000 piece of equipment, brand new, and that he had imported from Italy. Vehicles, dump trucks, semi trucks, heavy duty work trucks we've done. So, again, we measure collateral quantitatively by its value and qualitatively by its perceived ease of liquidation. This goes back to what I was talking about. And really, as a nonprofit lender, right, a CDFI, one of the things that we look at, again, how easy will it be to liquidate, in the event of a worst case scenario. So that's important, definitely. And again, because during liquidation, I think it's really important for owners, small business owners, to understand is, those business assets in those scenarios, they're sold at pennies on the dollar, just to liquidate and move, So again, our mission isn't around that, and we want to stay clear of that. So, but again, at the end of the day, collateral does help mitigate the perceived risk of any loan, by having that and being able to present to an underwriter, to a loan committee, and giving them assurances. That's what collateral does, for us in this particular circumstance. Questions on this one?
No questions on this. We do have some questions, but they're good to hold to the end.
Okay,
So we'll hold those to the end and then come back.
awesome. And just real quickly, Alex Londoño, he's a VP commercial banker from Bank of the West. He says that collateral is always going to determine how serious a borrower is. And one of the things too, again, often with the small business owner, and in this environment, one of their biggest piece of collateral and the biggest values they can bring to the table is their personal home. So a lot of times, again, those small business owners will use a home to use as collateral for the loan request. Character, that was people, had stated this in the beginning as part of the 5C's, but so this refers to, right, a borrower's reputation. That old adage that past behavior is the best predictor of future behavior. Is one that many lenders subscribe to, and again, back to starting out in the finance industry, but this was one of the first things that we were taught in terms of the philosophy around how we assess small businesses when they're requesting credit, even, mid to large size companies as well. This is huge. It's huge in terms of, again, building strength on an application around somebody's character. And this goes back to partly also some of the willingness, and their commitment and obligation to this process. And a lot of that we can, tell in terms with trending, and looking at personal credit. So as a CDFI, we pull personal credit. We don't pull business history credit. We use personal credit to make our determination on credit scores. We'll go out there and verify personal and business history. We'll go out and reach out to vendors, and see how well sometimes companies are with their payables, and how timely they are with those. Credit score, one of the first things in my conversations that I have with borrowers is asking, well, where are you at right now with your credit? Tell me a little bit about your credit score right now. And I don't expect people to be exact, but I do have an expectation around having some knowledge of where they're at with their credit, and having a good understanding. If I were to ask questions around that, they can respond accordingly. Sometimes I'll get a response, well, I don't know what my credit is. I haven't looked at it in a while. That's the last thing a lender wants to hear. Going into this process, for me, a best practice is to always understand that piece, because that's going to be crucial. That score, so there's an actual range. Again, let's compare the retail banking environment, right? And what they look at. You're probably going to see anywhere from 650, where it's going to be a minimum, and some people I have seen where they want to see that minimum, especially in today's environment. They want to see a minimum score of 675. Anything lower than that, they won't even look at you. And let's talk a little bit about where we're coming from and the environment that we're coming out of, right? And this whole COVID environment and what it's done to the economy, especially small businesses. But during those 2-year period, what I'm seeing a lot is people's credit scores were impacted greatly through that process. So understanding this, and what we do as a CDFI, being able to understand the narrative behind why those scores dropped, and knowing, prior to, because we can see that history, so it's important, to know and understand, what happened to your credit, and were you part of that fallout, with that. Were you gonna say something, Robert?
Yeah, well, I was gonna ask a question tying to this. So if I'm a small business or I want to start a business and my credit score took a ding during COVID in the last few years, what can I do now to either both improve my credit or help get that narrative? So when I approach the lender, I'm prepared instead of going in and then just getting denied and not understanding why. What can I do to be prepared on the front side?
No, definitely. So again, pulling your credit for one, right? Really kind of going through your credit with a fine-tooth comb and understanding, where you're at. Now, we see what we saw a lot is people got behind in payments. So they, we're seeing a scenario where late payments have kind of affected that score. There are some scenarios where we see some charge-offs or collections, and also scenarios where people use plastic, right, to help get their business through. So they use their credit cards and max out credit cards. So now their credit usage percentage has gone up. So understanding all those, variances that played a part, going back to and identifying and writing down, because I'll want to know exactly what it is. So writing down a letter stating exactly how you were impacted as a business and what you're doing to mitigate that score. Did you have a charge off? Did you get into an agreement with one of your creditors, and you're making payments to pay off something, or you're making payments to catch up? All these things are important, like for us, once we understand that narrative. And I think really, Robert, the biggest thing is understanding that somebody's willingness to go back and be proactive with making changes and helping improve that score. That's one of the big things. And again, going back to character, right? And going back to see, a person's commitment to that process. That's important. So I would say is really being able to write that narrative down and understand. Now, there are some situations where we look at where it's like, this is going to be too challenging, but let's do these things, or let's help get you in front of our business advising team so they can help find out a pathway to improve the credit score. So maybe 6 months down the road, we can revisit this, and take a look at it again. Because we want to know the story. We definitely want to know the story. And those are the things, that our small business owners can really be proactive with in seeing if there's finding viability, right, in an application.
We had a question that ties, are there any lenders getting close to doing character-based lending?
Well, from 500 to 10,000, we do, well, when you say character-based, do you mean credit is part of that? Looking at just credit only, or?
That came from Ryan. So Ryan, if you want to throw in the Q&A real quick. A little more clarification, we can try to.
But yeah, and I'll just kind of character-based solely without actually pulling credit. I don't see that. There's too much valuable information in a credit history in establishing trends, with the client. So definitely pulling credit only. Now, because a lot of times, we're a collateralized base lender, but up to 10,000, we'll look at an application without collateral. So if that's what he means, if it's just credit only, and there are lenders out there that just do credit only applications. A lot of that you'll get into, some of those fintech lenders, but typically interest rates are going to be, probably somewhere over 15% all the way up to 30%, on those types of, that helps, again, mitigate that risk piece of it.
Right. Excellent.
Okay. So one of the other things too, real quickly, I'm looking on here is, some of those collections, right, and charge-offs that we look at, medical debt, that's one thing that we're flexible with. And again, that's something a lot of, we understand in terms of, a lot of times people don't have control over that process. And we see that there are a lot of, insurance companies that will turn over, to collections, but, that's something we do look at. Now, one of the other things, again, is the credit usage piece that's important. But understanding that piece, are you maxed out on those credit card debt? And looking at opportunities, how do we, that in itself, looking at, we've done in the Maricopa County program, we did a lot of refinance on credit card, business credit card debt, and to help, get people out of that high interest rate payment environment. But that's something also to focus on and to understand. And there's a credit usage percentage on a credit report, that I'll first kind of zone in on when I'm looking at one of those. But so there's definitely, for me, there's a story to tell on a report. Firstly, I would say know what your score is. Understand your report. Everybody has access to a report on an annual basis, free, from all three credit bureaus, right? So get those, understand those, know where they're at, especially if you're going into a scenario where you're going to be requesting funds, for a loan. That's important to understand that piece. Let's go ahead.
Something you mentioned, Mark, and it ties back to that question about the character-based lending. And Ryan or share a little more in the chat. He said lots of small business owners, mom and pops, need small loans based on character only for 10 to 50K. Many of them don't have the best credit. Mm-hmm. And you mentioned sometimes that credit to show that character takes 6 months to clean up and improve and be proactive on. So I think that's real important, that going back to that, you're sometimes your character does show up in the credit report.
Oh,
so
yeah, definitely. No, without a doubt, and hence the word itself, right? We use, for that piece. It definitely, because I see it all the time. We'll get, and I'll look at credit reports and when people are very nonchalant about collection items or charge-offs, or a vehicle repossession, and don't have an explanation other than why I couldn't afford it, and give me more, but there's not really much more to provide. That's kind of indicative of what we, if that's that particular style, and I would say of management of the finances, we tend to see, more of those loans with a default. So that, and lenders as a whole, so they see that component, and that's where they stay away from that. But again, going back to where, take ownership, create a narrative around that, let us know and understand. I did a loan, but somebody had a credit score of 540, and there were some medical issues there. They worked, and working hard to get back on track, and was able to, again, talk us through this story to let us know, and it all fell in place. And it's like, man, and this was an $80,000 loan. They had real estate to use as collateral, but they've been on time with their payments ever since, and this is almost a year and a half ago. So we can find the stories there, and we can find, so it's out there. I just think, to Ryan's point, definitely, there's opportunity there. We just need to kind of find, and get over those hurdles as we see them. But I always like to share this quote. This is one of my favorite quotes. You're far out better to have tried something and failed than to have tried nothing and succeeded. And to me, this kind of like really identifies and highlights the entrepreneurial spirit of small business owners. And I've seen it so many times where businesses and people have been knocked down, and they keep getting up and they keep fighting, and then we see the successes at the end of the day from that. So just wanted to share that. But also, even through the lending process, it's like, is there opportunity? Can we find opportunity? Don't hesitate and on if we need to shall the request and revisit 6 months down the road, let's try to find that opportunity. Let's go to the next one here. So capital. So here is basically what we're looking at is, we view capital and what people have, in terms of their balance sheet, right? This allows us to see, in the event if a business was faced with hardship, do they have the necessary assets in place to weather the storm? Okay, so this we pull off of a balance sheet. So we take a look at this and we determine, let's see, how well, the financial management processes of this business for us to determine. One of the other things that we look at is, for a new project, for small business owners, are they coming to the table with, some skin in the game, right? And are they able to say, Mark, I have this expansion project, it's the overall project's going to cost me a couple $100,000, but we're footing the bill for about 50 of it. I need 150 for the equipment, for build out expenses and what have you. But you're telling me you're coming to the table with at least 25% down into that project. That's skin in the game. That's telling me that you have the foresight, to plan ahead, accumulate, this money to put in towards that project. So this is telling me that you're committed to that piece. So that's what we talk about when we look at what's, your skin in the game. So when an owner is fully invested, right, into their company, it's going to give them added incentive, 110% to repay that loan. That's what I see. When I see that attitude, and I see, when we look at tangible things that we can see and put, our finger on in terms of how well a business is saving, and manages their finances, it's going to speak a lot towards their commitment to repay that loan. So capital is huge, right? In terms of us being able to also create additional strength to an application, and that additional strength, again, these are all about the weaknesses and the strengths in this process. So when I'm doing a presentation to a loan committee or to an underwriter, I'm talking about and I'm listing the weaknesses and the strengths, or vice versa, actually the strengths and then the weaknesses under that application, and being able to identify that, by line item. And this is one of them. Okay. Sal Kabibo, he's we go way back in the Wells Fargo and Chase banking days, but he's a VP, commercial banker, extensive knowledge. But and I like this, and I use this because he talks about surrounding yourself with the right people as well. Get guidance from an attorney, CPA, business broker, people that understand not just your industry, but various industry. And I'm gonna talk about as well some best practices here as well. But let's go into focus here on our last slide. Conditions, refer to the terms of the loan itself, as well as economic conditions, that might affect the borrower. So we do have to, take that in consideration. But again, I just mentioned that the strengths and the weaknesses, right? And what we look at and what's important for borrowers, and something that I always want to share and really want to highlight, is industry specific borrower. Every industry is classified in terms of risk and how risky that industry is. So regardless of how strong your company is, on your balance sheet, on your P&L statement, you're already tagged with specific risks associated with your industry. And every lender follows these risk guidelines per industry, right? So understand that. As an example, professional industries are considered low risk industries. And when I say professional, we're looking at medical practices, law practices, CPA firms. That's a professional industry, and those are considered low risk. High risk industries in tourism, retail restaurants. Those are usually, and service related industries, sometimes we're going to get classified into those higher risk, levels, in terms of risk mitigation. Okay, so understand that, and understand the industry that you're in when you're requesting a loan. Ask that question. What are the risks associated with my industry, and how can I best help an underwriter look at an application and create strengths around that? So that's important to know. Uses of funds, huge. So as a CDFI, for us, every dollar we lend, in the event of an audit, we need to specify what that money was used for from every one of our borrowers. So it's very important to know and to understand uses of funds. Okay, the other side to that is when I get a borrower and they're looking at, some requesting funds, and, I see an amount, 50,000, I'll talk about the amount. And I'm like, well, let's talk a little bit about, what you need the 50,000 for. Kind of outline for me and highlight what those uses of funds will be. Well, I'm not sure yet. I haven't really thought about it, but 50,000, but I'll get what I can take. I'll get that response. And you're not ready. If I get that response, you are not ready for a loan yet. Okay. What I respond to is I'll let people know. I said, to better understand and position your business, we need to understand what you want that money for, because we're going to look at, and in order for me to make a case to my underwriter, understanding the uses of funds tells us that you need the money for your specific industry. If you're a service related industry and you kind of like Mary Maids, right? You're a house cleaning business, but you want a loan because you want to buy a vehicle, and the vehicle is a brand new 2023 Corvette, and you want to use it for your business, right? Well, it's most likely, that particular use of funds, we're not going to loan money for because we don't see the use or the value. Now, if it was a van, and you were going to, put signage on the van and use that van for, your equipment, from place to place, well, then that's a use of funds, for your request. So it's really important to understand and to have that conversation. And again, before coming to a lender, highlight it, and what I always tell people, put down a wish list, put your priority first and go down from your needs to your wants, and we can understand and we can get a good gauge. And this helps us by understanding, right, this piece of it too, when we go into evaluating the loan, and if we can't lend a full amount, if you wanted 100 and we really are comfortable with 75, we're going to look at that list, right? So that's something that we look at in terms of the conditions, right? But this particular, part of the 5C's of credit, really it's evaluated mostly qualitatively, right? Industry related. And I talked about that already, but also the terms of a loan, how is it going to affect the payment? That in itself is a condition, so those are the things that we look at and we consider on this particular slide here under the conditions. Robert, any?
Yeah, I think right now is a good time to mention that Prestamos, through their Women's Business Center and also through some of their counselors that they have, can help with some business planning at this piece. SCORE, Small Business Development Centers, and there's others that are no-cost providers. And this is where that business planning piece that they can help with is really crucial, because you're putting those projections in, you're explaining the narrative around your industry and your business, and that proper business plan just makes a better packet for the lender.
Without a doubt. And, I was in a conference in LA a couple of weeks back. And, one of the things that came up is small businesses don't take advantage of those resources enough. A lot of times, I didn't know you guys were out there. I didn't know this was available to me. But again, and again, thanks to the Arizona Commerce Authority for allowing us to be here. But this is how we get the word out. And you sharing this with your friends or other small business owners and knowing that these resources do exist and they're out there, and free of charge. So, definitely thank you for highlighting that, Robert. But let's just and we'll end it here. One of the things, I'd like to share with you is best practices, for all small business owners. Again, going into, a loan application scenario, but financial documentation is huge. I have a presentation just around this alone, but having, one of my biggest challenges as a lender is the lack of preparedness when it comes to financial documentation. What's needed and, why we need those specific documents. It's important to understand that. But financial documentation is hiring a good CPA, bookkeeper. Get a referral from a fellow business owner that has a good bookkeeper or CPA. Do your research, right, out there in the community. Those CPAs and those firms that have been in the community for years and years, that means that they're probably a good referral or good source for you. Maintain an updated profit and loss statement. This should be done, a rule of thumb, by the second week of the very next month. You should have an updated balance sheet and profit and loss statement. So if you use a bookkeeper or a CPA, that should be a rule of thumb to follow. Understanding a cash cycle, the ebbs and flows of the business. Every industry experiences seasonality. Understanding that is important as well. Always maintaining an updated business plan with projections. Business plan, I tell people this is a forever evolving process with your business, to always go back to and look at something. It's for experienced businesses, it's important. So when you're looking to do an expansion, it's just very easily adaptable into an existing business plan to put in what that expansion is going to look like. But so this is, but otherwise we are good. Just, for those of you out there, this is just kind of highlighting businesses that we funded recently: a midwifery practice, law firms, landscaping, mobile dog grooming business, water filtration business, a coffee shop, pottery shop, restaurants. We go the full piping and fabrication company. We just did that one, but we aren't industry specific. Where we find a need, we help out where we can. So definitely But here we are, we're at Q&A. So let's get into this, Robert.
Yeah, we got a few minutes, but there's some good questions. There's a couple different questions for the same person, it looks like, around PPP loans.
Mm.
And it says, what if a business took the PPP loan and is now in repayment? However, the business didn't do so well during the pandemic, so they don't have collateral to sufficiently pay back the loan nor obtain additional loan for business.
So it's challenging. It's challenging in terms of not being able to pay the PPP loan is a loan that should have been forgiven if the right documentation and process was followed. That was money that did not have to get paid back. But I mean, we work with businesses that have received PPP funding, and we still will fund those businesses. But going back to, when in terms of, I guess the biggest thing to really understand is the cash flow. Yeah, you could be, challenged, or maybe you weren't doing as hot, or generating as much revenue prior to COVID, right? And we're coming out of this where we see it. But the one thing that we're still going to look at is, are you making and generating enough income, right, to pay that loan back? So we do want to see net revenue, because ultimately that's how we decide on lending. Can you take on that additional debt?
Okay, so we have another good question. So go back to PPP, just a reminder, if you took a PPP loan out and you're making repayments, check with your lender. You may have missed the forgiveness part of that, and it might be forgivable if you used it for payroll as it was intended. You might also be getting mixed up between PPP and the EIDL, the Economic Injury Disaster Loan.
Right.
So check on those, but check with your lender. The EIDL has a super low interest rate, so you probably don't want to refinance that. It's probably as low as you're going to get on interest.
Oh yeah, no, we definitely always advise against refinancing that.
Yeah. So we have a good question from Sylvia here. It says, as a small business owner, will you may have a situation where the wife has a good credit score, but the husband does not? How do you help with that?
So, again, in terms of having a spouse, we do require a husband-wife team to be on the application. One person has good credit, the other one not so good credit. The good credit does help mitigate, the bad credit piece of it. But again, it doesn't take away the negative, or the challenges that the other person has with the low credit score. We're still going to want to see, the narrative behind that, because when we have a joint credit application, typically, in that scenario, usually the husband and wife are always on the same application, so what's the reason, where's the separation, and why one person has the lower credit? And we kind of deep dive into that a little bit too. But again, going back to when we talked a little bit, in length about the credit piece, it's building the narrative, understanding, what the reason is. But we do, if one has strong credit, we do look at that as an opportunity to help mitigate the lower score.
Okay. And then one last question. I know we're at time, so thank you for all for being here. We're going to go a little long with this question, but I think it's a good one to ask. It says, as a startup business who have not started revenue flow, how do we obtain a favorable loan? I would even say, how do you obtain a loan, not just a
Yeah, it's possible, definitely. Now, let's think about collateral. Collateral is huge in this particular scenario, right? In terms of strengthening that position when we look at lending money. Because here we are in a scenario where it's a startup business, right? And there's no revenue to look at to develop a DSC, that debt service coverage. Where's the repayment going to come from? So this goes back to two things: outside income, Okay, is there outside income? And we're looking at that piece. If there's no outside income, then what did they do in terms of capital, in terms of saving up to start this project? Do they have, you know, a nice little nest egg here that they can live off of to help them through that initial 3 to 6 month period where we look for what we call that break-even point? You know, so that's going to help as well. You know, so there's going to be different factors that we look at. You know, I'm not going to say it's not challenging, because if there's no income, then, you know, we need to rely. Now, right now, we have a an SSBCI program sponsored, where I work in conjunction with Arizona Commerce Authority, but this is a program that the state will help guarantee up to 50% of a loan if a small business owner qualifies under that program. So, you know, that 50% helps out if they own a home and they use their home as security interest and we're 100% fully collateralized. Then this allows us to better look at the projections that are going to be put in place for that revenue that's going to come through. So, you know, it's a great question. You know, I will leave by saying it is doable, but there are challenges that we need to make sure that we overcome.
Excellent. Thank you, Mark. We're going to go ahead and start to wrap this up. Thanks for mentioning the SSBCI program. Great program. And Stamos is one of our participating lenders in that. And so, like you said, it's a guarantee of the loan to help people get into loans for their business. So you can reach out to Mark for more information about that if you need to. Mark, thank you for your time and the presentation. Again, we are over a bit, so we will wrap up. We hope everybody enjoyed it, and we hope to see you next Tuesday on our next boot camp. But until then, everybody have a great week, and we'll see you soon. Thank you.
Okay, take care, everybody. Bye. Thank you.